Welcome to today's analysis. The American economy is showing concerning signs of distress due to recent tariff policies, creating significant disruption in financial markets. The stock market has taken a severe hit, with international investors pulling back and recession indicators flashing red. The market response to these tariffs has been unusually negative compared to historical patterns. Typically, tariff implementations lead to moderate market adjustments, not dramatic downturns. Traditional tariffs generally have a gradual impact on GDP growth, allowing for adaptation over time. For example, tariffs on imported vehicles usually create minor inconveniences for consumers buying foreign-made cars. While they pay more, that money often supports domestic manufacturing and American jobs. However, the current situation is unprecedented. These tariffs have affected multiple sectors simultaneously, disrupting established supply chains and business relationships. The immediate impact has been a 20% drop in stock market values, with concerning patterns in bond yields, currency fluctuations, and consumer confidence metrics. The rapid implementation and broad scope of these measures have left businesses struggling to adapt, creating widespread uncertainty that investors dislike. This has led to defensive positioning and reduced investment in growth opportunities. Understanding these dynamics is crucial for anyone with market investments or retirement savings concerns. The traditional wisdom about tariffs and their economic impact doesn't fully apply to our current situation, explaining the dramatic market responses. Stay tuned as we explore how these tariffs affect different economic sectors and what it means for your financial future. This news segment is sponsored by Nebula, your source for in-depth analysis and expert insights. In a significant shift from traditional trade policies, recent economic measures have created unprecedented uncertainty in the American market. Unlike targeted protective measures, such as specific tariffs on Chinese electric vehicles aimed at protecting domestic manufacturers, we're seeing a dramatic expansion in trade restrictions. The current administration has implemented a sweeping 10% tariff across all imports, with higher rates imposed on most trading partners and few exemptions. This policy shift has pushed America's average tariff rate to 23%, a six-fold increase from the previous year and the highest level in over 100 years. Economic analysts are concerned about two major aspects. First, their extensive scope could potentially backfire on American manufacturers. While targeted tariffs traditionally protect specific industries, these comprehensive barriers are increasing costs for imported components, potentially making American products less competitive in all markets. The second concern focuses on the unprecedented uncertainty surrounding these tariffs. Market participants and business leaders struggle to predict how long these measures will remain or how trading partners might respond. This uncertainty complicates long-term investment decisions and supply chain planning. The effects extend beyond immediate trade relationships. When companies can't reliably predict costs or market access, they delay investments and hiring, creating a self-reinforcing cycle of economic slowdown and market instability. The contrast with traditional tariffs is stark. Historical examples show that focused trade measures, while distorting specific market segments, allow other sectors to operate normally. However, the current approach affects every sector, creating complex consequences economists are still analyzing. Market analysts are particularly focused on how these tariffs might affect America's global competitiveness. While intended to protect American interests, the unintended consequences could ultimately harm the industries they're meant to protect. Economic experts are raising alarms as market uncertainty reaches record levels due to Trump's tariff policies. The Federal Reserve's Trade Policy Uncertainty Index has hit historic highs, creating widespread concern across the American economy. Goldman Sachs has significantly revised its recession forecast, with probability rising from 20% to over 60% if Trump's tariffs take full effect. This aligns with predictions from betting markets like Polymarket and Kalshi, which show similar recession probability increases since February. The impact is evident in the stock market, with the S&P 500 falling 20% from its February peak. This volatility reflects a fundamental shift in economic confidence affecting American households and businesses. The situation affects investment patterns significantly. When uncertainty rises, businesses and consumers restrict spending and investment. This directly challenges Trump's reindustrialization plans, which require trillions in sustained investment, unlikely in such an uncertain climate. Further complicating matters is the American economy's dependence on its wealthiest citizens. The top 10% of earners now represent half of all consumer spending, making market stability increasingly dependent on this small population segment. The Federal Reserve faces unique challenges balancing these market pressures while maintaining economic stability. With tariff policies creating uncertainty and wealthy consumers having outsized influence on economic demand, traditional monetary policy tools may face new limitations. For everyday Americans, these factors create unprecedented economic uncertainty. Whether planning retirement, considering major purchases, or making investments, the current environment requires increased caution and careful attention to market signals. In a concerning development for financial markets, traditional safe haven dynamics appear to be breaking down, signaling deeper economic troubles than initially perceived. Market analysts are reporting unusual patterns in both stock and bond markets that could spell trouble for the American economy. The most alarming signal comes from the Treasury market, where investors are displaying unprecedented behavior. Typically, during market downturns, we see a flight to safety, investors selling stocks and buying government bonds. However, current market movements show investors dumping both stocks and treasuries, raising red flags among financial experts. Monday's trading saw the 10-year Treasury yield surge from 3.9% to 4.2%, a remarkable single-day move that suggests waning confidence in U.S. government debt as a safe harbor. This development carries two crucial consequences. Global investors may be losing faith in the United States as a premier destination for safe investments, and higher yields will increase borrowing costs for the federal government. This market behavior comes against the backdrop of broader economic concerns, including the impact of recent tariff policies that have pushed average tariff rates higher. The resulting market uncertainty has contributed to a 20% decline in stock values, primarily affecting wealthy Americans whose spending patterns typically help buffer economic downturns. The combination of falling stock prices and rising bond yields creates a particularly challenging environment for economic stability. These movements suggest that investors are reassessing their view of American financial markets' fundamental safety, a shift that could have long-lasting implications for U.S. economic leadership and fiscal policy flexibility. For ordinary Americans, these market dynamics could translate into higher borrowing costs across the board, from mortgages to car loans, potentially accelerating the path toward recession. In a concerning development for American financial markets, traditional safe haven assets are showing unusual behavior that could signal deeper economic troubles ahead. Financial analysts are raising red flags about the federal government's massive debt burden, which has reached approximately 120% of GDP, coupled with a substantial deficit running at 6% of GDP. The situation appears poised to worsen under potential Trump policies, particularly his proposed trillion-dollar tax cuts without spending reductions. Market experts point out that previous attempts to address budget concerns have failed to achieve meaningful results. What's particularly troubling is the break from historical patterns in Treasury and dollar performances. Traditionally, U.S. Treasuries and the dollar have served as reliable safe haven assets during market uncertainty. However, recent market behaviors suggest this dynamic may be shifting, indicating a loss of confidence in American financial stability. The current market response represents a departure from expert predictions. Initially, analysts expected Trump's tariff policies to strengthen the dollar, reasoning that trade restrictions would impact trading partners more severely than the domestic economy. Adding to these concerns is the possibility of a recession, which would strain government finances through reduced tax revenues. With Treasury yields remaining elevated due to investors' waning confidence, some experts warn of an impending debt crisis. The combination of high government debt, substantial deficit spending, and unusual market behaviors creates a perfect storm of economic uncertainty. This situation becomes more complex when considering implications for international trade relationships and monetary policy. Financial observers note that these developments could signal a shift in how global markets view American financial instruments, potentially challenging the U.S. dollar's status as the world's reserve currency. The ramifications would extend beyond immediate market impacts, affecting international trade and domestic fiscal policy. Breaking economic news that directly affects your wallet. The U.S. dollar is showing concerning weakness against major global currencies, signaling what experts call a perfect storm of economic challenges. Our financial analysts are tracking a dramatic shift in international confidence regarding American currency stability. Let's break down what this means for everyday Americans. The dollar's decline against international currencies carries a double threat to your purchasing power. First, it reflects waning global trust in American economic leadership. But more critically, it could trigger a dangerous inflationary spiral when combined with existing trade policies. Economic advisors believe Trump's tariff strategy would work because a strong dollar would offset price increases from trade restrictions. The logic was simple. Even if tariffs pushed prices up, a muscular dollar would keep imported goods affordable. However, this protective buffer is now eroding rapidly. Financial experts warn about potential inflation rates reaching 5%, levels not seen in years. This scenario could force Americans to face higher prices across the board, from groceries to electronics. But there's another layer, a looming conflict between the White House and the Federal Reserve. While President Trump advocates for growth-stimulating interest rate cuts, the Fed may need to raise rates to combat inflation. This policy clash could create unprecedented tension in America's economic management. The situation mirrors historical patterns of economic instability, where competing priorities between political leadership and central banking created market uncertainty. Analysts worry about potential presidential pressure on the Federal Reserve, which traditionally maintains independence in monetary policy decisions. For consumers, this complex economic chess game could mean higher prices, uncertain investment conditions, and potential market volatility. Financial advisors suggest reviewing retirement portfolios and considering inflation hedging strategies as these economic crosswinds intensify. Financial analysts warn of an unprecedented crisis of confidence, potentially more severe than any economic downturn in modern history. This comes amid escalating tensions between global powers and erratic behavior from key political figures. The situation has been complicated by Elon Musk's controversial statements and Tesla's public image challenges. Meanwhile, former President Trump's unconventional approach to international relations continues affecting global markets. Trump's tariff policies have led to a 20% drop in stock market values, with Treasury yields showing patterns suggesting declining confidence in U.S. financial stability. The increased tariff rates have created a ripple effect throughout the economy. In our WTF USA series on Nebula, we explore these political dynamics with a lighter touch. The show breaks down complex political events into digestible segments, examining Musk's Twitter pronouncements and broader political implications. Nebula features content from creators like Tom Nicholas, whose Boomers series examines generational inequality, housing crisis, climate change, and pension concerns, factors contributing to market instability. The dollar's weakening position has raised inflation concerns, potentially conflicting with Federal Reserve policies. This comes as the conflict near Russia continues influencing global economic patterns and energy markets. As geopolitical tensions remain high and political statements become more chaotic, investors and analysts are monitoring developments closely. The combination of domestic policy shifts, trade disputes, and global power dynamics suggests unprecedented economic uncertainty. Stay tuned to our coverage as we track these developments and their implications for both domestic and international markets. Good evening, and welcome to our in-depth analysis of contemporary American society. Tonight, we're exploring a fascinating phenomenon that touches every aspect of our nation's current trajectory: the lasting impact of the baby boomer generation. But before we delve into this compelling story, let me share something valuable with our dedicated listeners. Many of you have been asking about where to find more substantive, well-researched content that goes beyond the surface-level reporting you often encounter. That's why I'm particularly excited to tell you about Nebula, a unique streaming platform that's actually owned by independent content creators. This isn't your typical corporate-controlled media outlet. What makes Nebula special is its commitment to thoughtful, analytical content. You'll find exceptional creators like Real Life Law, who breaks down complex legal issues in ways that actually make sense, and Legal Eagle, who provides fascinating insights into the intersection of law and current events. Wendover Productions and Neo are also part of this impressive roster, offering deep dives into topics that matter. For our regular listeners who appreciate our analytical approach to news, you'll be pleased to know that all our standard programming is available on Nebula completely ad-free. In fact, Some content appears there before anywhere else. We're offering our listeners a special opportunity to join this platform at a significant discount. 40% off the regular price, making it just $36 for an entire year, or $3 monthly. As we prepare to examine the complex legacy of the baby boomer generation and its profound influence on American society, economy, and politics, I encourage you to consider broadening your news consumption through platforms that prioritize substance over sensation. Think of Nebula as your companion in understanding the deeper currents shaping our world. The link for this special offer is in our description below. Now, let's turn our attention to the fascinating story of how one generation's decisions continue to shape our national dialogue and economic future.